I think about the three kind of big picture pillars of a financial plan. There are really three things that we focus on. One of those things is income creation and how you maximize or optimize your income strategies whenever you're ready to retire. The second is how you grow your assets. And then the third, so I'm kind of going backwards here. The third is how do you purchase and acquire either the things that you want to buy, like a car, or cash flow type assets, things like real estate, private equity, that sort of thing. And so we really feel that in order to build a truly robust financial plan, you have to have all three of those things, right? The purchasing strategy, the investment strategy, and ultimately a strategy that maximizes the income you get to spend and enjoy during your lifetime. And so some of the tools that we're going to talk about really have a broad scope, and they can help in all of those categories or two of the three. And then some of them are more isolated. So today, we're going to talk about how we can eliminate dependence on bank lending and credit. And this is in particular one of my favorite things to talk about. And I'll give you a little history. So I'm Mary Lyons, the Wealth Woman, and I own Benchmark Income Group. And I have the privilege of working with some of the brightest and fun people, I think, in our industry. So, and that's the person who invited you today, right? I get to spend time with them. But the story of how I came to this strategy, I think, is kind of a funny one. So I will share that with you, and it will give you some insight into the way we operate and the way we look at things. I came into the financial services industry in probably 2005, 2006, and I really was excited to be part of the business. But I was about 25 years old. I was very young. And while I had a lot of energy and a lot of excitement, I like to think there was some intellectual horsepower there too. I didn't have a lot of knowledge. And I had some from growing up with a dad who was a financial advisor. And I didn't realize until later how much of that had really sunk in. But when I joined the industry, I was given the opportunity to learn from a mentor. And Kara, I'm just going to ask you to check real quick. I'm getting some sound on my end. So if you want to make sure the attendees are muted, that'd be great. So when okay, sorry, I got muted. So when I joined the business, my dad said to me, you know, it would probably be a good idea for you to find a mentor, and specifically to find a mentor who is a woman in financial services, because the challenges are different than what a male advisor would encounter or come up against. And it might just be good to have someone you can talk to. And so he introduced me to a woman who was actually one of the original financial advisors for Robert Kiyosaki, who wrote Rich Dad, Poor Dad. And she was nice enough that she agreed to mentor me. And she made a book recommendation early on. And she told me to read a book that is called Becoming Your Own Banker. And the author is a gentleman named Nelson Nash. So I immediately went out and I bought the book. And at the time, Amazon was either just becoming an option or not quite an option. And so I had to order it directly off of his website. And the book came and I read it. And my mentor, whose name is Kim, said, Mary, what did you think of the book? And I knew this question was coming. So I had read through the book. I didn't understand all of it. I went down the hall, I talked to my dad, and I said, given all of your experience with these tools and all of that, what do you think about this book? So he kind of skimmed it and he came back to me and he said, it's too good to be true. It doesn't work like that. And so I kind of took that as gospel, and I got back on the phone with Kim. And when she asked me, what did you think of the book? I regurgitated exactly what my dad had said. It seems too good to be true. And I don't think it works like that. And Kim's response was not particularly nice. Her response was, you're an idiot. When you figure out why, you can call me back. And I thought, is this really how people treat each other in the professional world? I don't understand what's happening. But she was so busy and working with so many clients that she was like, I'm not spending time with you if you can't develop the critical thinking around this. And so I marched down the hall. And I went into my dad's office again, and I said, you made me look like an idiot in front of Kim. And he said, no, you did that yourself. And I said, would you mind rereading the book and really delving into it and helping me understand how this works? And he said, sure. So he went home, he reread the book, he messed around in our software, and he came back and he says, it works. And I said, great. Can you help me understand why? And he said, you need to figure out for yourself why it works. And so I spent probably the next 6 to 9 months running different illustrations, figuring out proposals, example after example after example. And I tried to recreate everything that was actually in that book. And at the end of a 6 month time period, I had thoroughly convinced myself that it did indeed work, but I could not articulate why. And so I immediately decided to implement the strategy in my own life because I did not feel comfortable talking to clients about it if I couldn't explain exactly how it worked. And so I ended up using the system for probably another year, maybe even year and a half before I started talking to clients about it. And at some point during the process of actually going through and doing the functions of this strategy, it began to click. And then I was fortunate enough through the years to be introduced to people who created software programs that made it easier to explain because you could input numbers and go through different examples. And so what I really want to do for you today is short circuit the learning process so that it doesn't take you 2 or 3 years to understand how this process works. But we can get you to a place or to a position in your own situation where you can start to have complete control over the financing functions of your life. So that being said, we are going to jump right into this. This is our beautiful disclosure page. I just want you to know that the attorneys and the compliance guys require us to have this up there. If at some point in time you'd like to see a copy of our presentation, we can certainly send that to you. That being said, we're going to jump in. One of the things that I think is really important when we are talking about wealth is getting a really good understanding of who the information is actually for. So if we are listening to the advice that somebody is giving, we need to know who their ideal target market is. So I'm going to start with a question. And we're going to put this up as a poll so that you have the opportunity to answer. And then once we get through this, we'll share some of the answers so that you can kind of see it. So if you think about all of the households in the United States, each household is bringing in an income. What do you think you would have to be earning as a household, not just an individual, but as a household, in order to be in the top 50% of all households in the United States? So 50% of the households are earning less than this number, and 50% of the households are earning more than this number. So Kara, would you mind putting that poll up there for everybody? So kind of be thinking about this just in the back of your head. And I haven't seen it pop up yet, so I'm not sure if I have a different view. And we'll just give you guys a couple of minutes to answer the poll. So you can kind of write it down on a notepad to the side. And then once we have some answers kind of coming in, Kara, if you want to share the results. And I can't see it. So if for some reason it's not working, will somebody just shoot me a text? That way I don't stay here. Because I know my view is a little bit different. Okay, so now that you have that, I want you to think in terms of what does it take to be in the top 25% of all households in the United States. So 75% of the households are earning less than this, and 25% of the households are earning above this. And this is annual income for a single or dual earner household. All right, now write down off to the side, if you've got a notepad, what does it take to be in the top 10%? And then ultimately, what does it take to be in the top 1% of all earners in the United States by household, right? So I want you just to think through this. And what I'm going to do now is the reveal. The reason that I'm asking this is because frequently when we talk to people, they don't know exactly where they fall from an income perspective. And so they may be listening to people who are giving advice that is really not geared towards them. So the first kind of number here, in order to be in the top 50% of all households in the United States, you only have to earn more than 40,000 a year, right at $40,000 a year. If you earn less than that, this is the thing that I think is kind of crazy. Half of the households in the United States are earning less than $40,000 a year. To be in the top 25% of all households in the United States, your combined income needs to be 80,000 or higher. In the top 10, it's 138. In the top 5, it's 195. And then in order to be in the top 1% of all households, you have to earn about 480,000. And I think this is just good for context, because the strategies that you should be pursuing if you're in the top 25% of all earners are radically different than the strategies that you should be pursuing if you fall into that bottom 75%. And yet a lot of times what happens when we're listening to the talking heads who have radio shows and who are putting a lot of content out there is that frequently the advice that they're giving is geared towards the masses. So the 75% or the 90% of earners that are out there. What's interesting about this, and I'm going to stay away from the politics of it, but I do think this is important when you're looking at strategy, is that the top 1% of all earners in the household are responsible for paying almost 40% of the taxes collected by the IRS. Now, obviously, there's a heavy skew towards income, but I think one of the things that is important to understand here is that frequently for people who are making, $1.5, $2 million or more on an annual basis, they're working with tax attorneys who are delivering very different strategies than what people are making if they're in that 500 to a million range. And so even in that 200 range, when you look at the total taxes collected, and these are cumulative, so they're not going to add up to 100 because the 5% includes the 1% and the 10% includes the 5. You can see that the top half of all earners in the country are responsible for almost 100% of the taxes being collected. So I think it becomes very important as we're looking at strategies to find strategies that allow us to have either tax-free growth or tax-free access to our money, because taxes cause a lot of erosion when it comes to wealth building, and it's important to have that protected. So that being said, what we're going to jump into is a little bit about how people learn and where people get stuck. So we're going to think about the world of knowledge as a giant pie. And we know that there's a slice or a sliver of this pie that are things that we know to be true. So when I think about the things that I know to be true, there are things like the values that I hold dear. They are, technical things that I've learned in school over time. And that is just a piece of all the knowledge that exists in the world. I also know that there is a sliver of this, probably a bigger chunk than what's depicted, that are things that I don't know, but I am aware that I don't know these things. So maybe astrophysics is something that I could include here. I'm aware it exists. I know there are people who are experts in that arena, but I also know that I don't know much about that. And then there's also the blind spot. So the blind spot are things that exist in the world of knowledge that I don't even know are out there. And so I don't know that I should be looking for them or that I should be educating myself on those things. And when it comes down to it, there are really only 3 ways that people can expand their piece of the knowledge pie. And that is through the experiences that they have. I know that for me, sometimes my learning style is that someone may tell me, hey, you shouldn't do that, but I have to do it and suffer the consequences before I actually learn the lesson that's attached to it. I see my kids doing that as well. Personal study. So this would be things like the books that you're reading and the things that you're researching. And then the last way is transferable knowledge. So this is talking to people that have already had an experience or the knowledge that you need, and then they transfer it to you. So hopefully today we're able to fall into that last category and at the very least trigger a desire to have personal study in some of those areas. So when it comes down to it, let me go back one. Here's the last piece, and this is the piece that I think is so important. Where people really get stuck are the things that they know that just aren't so. And by that, I mean, we all have things that we believe to be true. I like to call them preconceived notions sometimes, things that we are just absolutely certain are the truth, and we may actually just be factually wrong, right? And so we're going to spend some time talking about the things that that could fall into that category. So we're going to start by playing a game. And I think when we play this game, Kara, is there a poll related to this? Yes, there is. So you're going to have a chance to answer this question. Let's say that you are getting ready to go buy a new car. What I want you to do in your head is just think of the amount of money that you're planning to spend on this new car. So whatever that number is, just hold that in your head. In this example, we're going to say that you have that much money sitting in cash at the bank right now. And you've heard that paying cash for major purchases, especially a depreciating asset, could be the best way to do it. So you walk into the bank, and in this example, we're going to say that you're buying a $30,000 car. So you walk into the bank and you say to the banker, I'd like to make a withdrawal today. I need $30,000. I would like it in $1 bills because I think it's going to make a bigger, fatter stack. And I want you to stick it in this briefcase because I'm going to walk down to the dealership, and I think they're going to get so greedy when they know I have this cash on hand that they are going to make me a really good deal. And so the teller kind of looks at you for a minute and says, could you hold on just a minute, please? And goes to the back and gets the big banker, right? So here comes the big banker, and he comes out and he says, how can I help you today? So you repeat the same story, and he says, no. We really like having your money here at the bank because when you leave your money with us, we can lend it out multiple times. So in order to keep your $30,000 here at the bank with us, what we're going to do is we are going to give you a rate and a program that is just for you. We're going to move your $30,000 to a special account where you can earn 4% every year, net of taxes, net of expenses. And I know you can't get that anywhere else on your cash right now because have you seen what interest rates are doing? And so we're going to move you to this account. But we know you need to buy this car. So what we're going to do is we are going to go back into the vault, and we are going to take $30,000 of the bank's money, and we are going to loan it to you. But we're going to charge you 6% on our money. So we're going to pay you 4% on your $30,000, and you're going to pay us 6% on our $30,000. And I promise you're going to come out ahead. Do you believe the banker? So I'm going to pause for a second so that you all have a chance to answer the poll. Right?
Most are saying no.
Most are saying they do not believe the banker, right? So I am willing to guess that some of the people saying that they do believe the banker either are bankers themselves or they've already seen this presentation or part of it at least once, right? So I will tell you that in all the years that we've been playing this game, and we play it with most of our clients, most of the time people say no, whether they're a CFO and they deal with numbers all day long, or they're a banker themselves in some circumstances. So the fact of the matter is that the banker is telling you the truth. So I'm going to walk through how we know that. And this is an example of a time that your gut response means that you need to delve a little bit deeper into how this works. We are trained to focus on rate, whether that's rate of return or the rate that we're getting on a loan that we're taking. And the problem with doing that is that we miss the bigger picture, which is the flow of money. That's very different than the rate. So let's look at what's happening. So if I have $30,000 sitting at the bank and the banker moves that into an account where I can earn 4%, I'm going to earn interest on that account. And so at the end of the first year, all of the interest that I have earned is going to be credited to my account. And so now instead of having $30,000, I may have $31,250, whatever the number is. It's somewhere in that range. So that same dollar amount now is bigger. And even though it's earning the same interest rate, I have more money working for me. So I'm receiving more in interest. This is the basics of how compound interest works. Every year I'm getting credited more and more growth. So we've looked at a 5-year time period just because that's the length of a typical car note. And if you were to leave your $30,000 at the bank earning 4%, over a 5-year time period, you would earn $6,630. So I just want you to write that number down or keep it somewhere in your head because that's the amount of interest that you earned. Now let's look at what happens with the loan. A $30,000 loan at 6% over 5 years means that your monthly payment is $580. Every time you make a payment on the loan balance starts to shrink. The company who has issued the loan, the bank, can only charge you interest on the amount that you still owe. That's why when you look at your house payment, initially it's almost all interest, and by the end, it's almost all principal, because when you have a lower balance, the amount of interest being charged is also lower. And so what you can see is every year that you have the loan, the amount of interest that you're paying is shrinking because more and more of your payment is going to principal. So if you paid that car off by making the regular car payments over 5 years, you would pay the bank a total of $4,799 in interest, which is less than what they gave you in that account, than what they credited to your account. And so if we do the math on that, you come out ahead, right? The side-by-side comparison, you can see that you've got an extra, let's call it $1,800 in your pocket, simply because you kept your money earning and working for you during that time period. So if you're looking at this and you're saying, yeah, that's great, but I would never take a 6% car loan because have you seen my credit? It's amazing. So if you go to a credit union right now or some of the car dealerships, you might be able to get a car loan as low as 2%. So let's look at what happens if we have a 2% rate instead of 4%. At a 2% interest rate, my payment drops from 580 to 526. And over that same 5-year time period, the amount of interest that I pay is $1,550. So if I look at the difference between what I have paid in this scenario and what I have earned, I am net ahead by about $5,000 in this scenario. So what does that actually tell us? What that tells us is it makes sense to get our money on the compound growth curve as quickly as possible so it's earning for us, and then to find the cheapest money we can whenever we're getting ready to make a purchase. So let's say, okay, this is still debt. What happens if I were to pay cash? So if you were to operate in a cash system and you took your $30,000 out of the bank, it is no longer in a special account where it is earning 4% for you, right? And so even if you said, I'm going to put the money back because I know I'm going to buy another car in 5 years and I'm going to pay myself with interest. If you paid yourself back with 2% interest, which let's be honest, who actually pays themselves back with interest, then you would end up with $30,000 plus the money you paid yourself. So $31,550. Well, if I keep my cash flow the same, and in one scenario, I end up with $31,550, and the other scenario, I end up with $36,630, which one would you rather be? Because I would rather be the person that had more money in my account at the end of that experience. So this is why when we look at this and we're just looking at the economics, what we find is it makes sense to keep your money earning for you if you have the use of someone else's money. So why would you want to do it this way? Let's talk for a minute about what happens when you are trying to build wealth. We're going to look at an example where you're saving $6,000 a year. And we're going to just make the assumption for the purposes of this example that you could get a 5% rate of return over the next 50 years. So the reason that I'm doing 50 years here is that I am taking my age, which is not quite 40, but we'll round up. And I'm saying, okay, what would happen if I saved $6,000 a year for the next 50 years? I'd be 90 at the end of this. What we're going to do is make the assumption that every 5 years, I am going to take a loan. So if I could just put $6,000 onto the compound growth curve, earning 5% every year for the next 50 years, at the end of that time period, if you follow this blue slope right here, I would have $1.3 million. So if I was making $60,000 a year and I could save 100% of it, I'd have $13 million in change. If I'm making $600,000 a year, I get to add 2 zeros, right? And I would have 132 million if I could save all of it. And yet when you think about what happens to most of us and you think about, here's how much money I'm making. Now I've got to pay taxes. Now I've got to pay my mortgage, student loans, if we have them, and any other type of debt. Already you've eaten up a large portion of your income. And then when you take what you're spending on lifestyle, things like car purchases, vacations that you're taking, all of that, the amount of money that you actually have to save is much smaller than the income that you were earning in the first place. And so what happens is we tend to focus on this tiny little bit of money that we're able to save. And then we put a lot of pressure on it saying it's got to earn a really high rate of return. But if we had the ability to earn on the money that we were spending, whether it's taxes, whether it's debt, if we could keep some of the compounding on that money, even if it was compounding at a very conservative rate, that big bulk compounding at a lower rate is going to do more for us than that little amount that we're saving with all the pressure that we're putting onto it. So when you look at what we're really illustrating here, what most people would do in this scenario, assuming that we're again looking at a car example, right, $30,000 or so over that same 5-year time period, is that people save up the money and then they take the money off of the compound growth curve. And then they save up the money again, and then they take the money off the compound growth curve. And then they save it again, and then they take it off the compound growth curve. And so when you do this repeatedly, what really happens is you lose all of the beauty of compounding, right? And it was Einstein, I believe, who said that compounding is the eighth wonder of the world. And so if you look at what happens, just that use of the money and pulling it off of the compound growth curve means that I lose almost 100% of the money that I could have had. And so if we can keep ourselves on that compound growth curve without giving the use of the money up, we still have it, we can still access it. Even if we don't maintain 100% of the compounding, the ability to recover and hold on to at least a portion of that is the ability to complement whatever we're doing with our other investments. And so I want to make sure that as we're going through this conversation, we aren't thinking, well, either I can invest or I can build a purchasing strategy. What we really want to do is both of them at the same time. So instead of either or, we want to start using the word and. So how does this work? What I'd like to do is distinguish between a cash-based system and the private reserve strategy, just in a very simple, easy, visual way. So when you think about what happens in a cash-based system, if I need to make a purchase, I first have to save up the money. As I save the money, and in this example, we'll just say it's $20,000, I know that if I am putting it somewhere that it is liquid because I'm going to use it either to buy a car or to make an investment, that in this environment, I can expect somewhere between no interest and maybe 2% in interest. So it's not going to be a particularly high rate. I know that I'm going to put that into an account and the account is going to be taxable, whether it's a checking account or a savings account. At the end of the year, any interest I've accrued, I'm going to get a 1099 for that. And I'm only going to be able to earn on whatever is in the account. And so if I say I have saved up 20 grand and I'm going to take 10,000 of that out for a purchase, I lose the growth on that money and I can only earn on what's remaining, the remaining cash balance in that plan. So what we're going to say is let's create a totally different strategy. So we're going to call this the private reserve strategy. And just like the cash-based system, we have to save up the money. That's the first thing we have to do is save up the money. But when we look at what's happening in this account, we can expect over a lifetime for this account to earn somewhere between 4 and 6%. And we're going to use 4% just to be conservative. What we want here is the use of our money, the control of our cash flow, because that's the beauty of cash. I don't owe anyone money. I can replenish it however I want to. And we want uninterrupted compounding because we're not getting that in the other system. So whenever we get ready to make a purchase, what is going to happen is a financial institution is going to put a lien against our private reserve, right? So they're going to say, we're going to leave all of this in the account. We're going to hold it as collateral, and we're going to go into our general fund or our vault in order to make you a loan, right? And so you can see the loan here coming out. Whenever we give that loan is going to come to you. And let's just say we're doing 6% because that's the number that we used in the car example. So the bank loans it to us at 6%. We know that as long as we are making payments back to this over time and replenishing it so that we can then deploy the capital another time, right? Either to buy another car in the future or another investment, we've got the access to the capital that we need. And we know that the math works in our favor. Now, if this is structured correctly, the beauty of this system is that you get a completely unstructured loan. By that, I mean it is an interest-only loan, but you get to decide the payment amount that you make or if you make a payment at all. So the timing of that payment is completely up to you. And then if you want to charge yourself a higher interest rate, you absolutely can. So if I had credit card debt that was at 20%, and I'm able to shift that, and an institution is going to loan it to me at 6%, I could choose to continue to pay the 20% that I was paying to the credit card, only now 14% of that is going to go flow right through that institution. It's just a pass through, and it will end up adding to my entire private reserve. So I get to determine the payback strategy on this as well. So let's say I loaned myself 20 grand. I could choose to wait 3 or 4 months before I made a payment, and then I could make a $10,000 payment, and then I could pay $1,000 a month every month after that, and then I could pay it off. Or I could choose not to make a payment for a year. So all of this flexibility is really the exact same flexibility that you would have in a cash-based system. But the difference is your money never comes off the compound growth curve. So when you compare the two together, you get a higher interest rate than you would get on your cash. You get all of it compounding without interruption, and you still have the use of all of the money that you need access to. Right? And the growth here is going to be tax deferred. But again, if it's structured correctly, you're always going to have tax-free use and access to the money. So where do we actually do this? How do you build something like this? The most common question that I get when we're talking about this strategy is, yeah, that all sounds great, but where can I get 4% on my cash? And the answer that nobody ever likes to hear is life insurance. A permanent life insurance contract, when structured correctly, can provide exactly the details that exactly the program that we're talking about here. And I find this to be really interesting, because if I could change the name of the tool, just the name of it, and call it anything else, people would have a different response. But I do sometimes find when people hear that, they're like, oh God, okay. But they don't realize that you can do this. And this, I'm going to go right back to it, right? Just like we didn't believe that the banker was telling the truth, and the fact of the matter is that that it does work in your favor. There are plenty of financial tools that are available and out there for us to use right now that people have preconceived notions about, right? They think it works one way, and it actually works in an entirely different manner. So what I'm going to do is give you a quick tutorial here, because when you begin to see the difference in the way we structure a contract specifically for this system, it'll start to make sense to you. So when I think about the most expensive way to acquire life insurance, it's term. And I know some people are probably saying, what? Term is the cheapest way you can do it. That's true in terms of cash flow. But when you look at the actual cost of a term insurance policy, 100% of what you're paying is cost, unless you happen to pass away. Because what you're doing with term is you are essentially renting a death benefit for a short period of time. You get a very high death benefit, but you're never building cash. And so if you live beyond the duration of your term insurance, 100% of what you paid is cost. So if you think about this like an efficiency scale, term is at one end saying it is a high death benefit, but you're never building cash or access to cash. So if we go to the other extreme, what we're looking at is something called a single premium whole life insurance policy. What you find with a single premium policy is that you get a very low death benefit, very low, but you have a very high cash value. So if we are designing this system for growth and access to cash, death benefit is kind of a secondary concern, if it's a concern at all, but the primary concern is access to cash and liquidity. So if you were to purchase a single premium policy and you look at the overarching structure, if you were to put $100 into this policy, you're basically paying cash for an insurance contract. So that $100,000 might buy you $300,000 of permanent death benefit, depending on your age and your health rating. But the cash value that you would immediately have access to the next day is probably going to be somewhere between 87 and 93%, depending on the insurance company and the year and the age. So we'll just say 90 for round numbers, because that's easy math. So when you think about how these contracts were originally structured in the early 80s, you're looking at paying cash for insurance in a double-digit interest rate environment. So if I could put money into this contract and within a year I have recouped 100% of the cost of my insurance, then I've got the ability to immediately start touching that cash, putting my hands on it, right? So if I have use and access to the cash, I have tax-free growth and access to the money, I have a double-digit return in that environment. and I have a death benefit, and I have protection from lawsuit and creditor. When I look at all those benefits, it's a pretty sweet deal. And so if I compare that to investing in the stock market in the 80s, I can have a double-digit return with a guarantee of my principal, or I can put it in the market where there is no guarantee of my principal and I can hope to get the same double-digit return. And so people began taking their money out of the stock market and putting it into these types of contracts. And then still other people looked at their CDs and the money that was sitting in cash, and they said, wait a minute, I can get a higher interest rate with a bunch of other features and benefits in these contracts. So they started pulling their money out of the banks. Well, the banks in Wall Street clearly didn't like this. And so they, went to their lobbyists and they said, this is a problem. You guys need to get to work. You need to fix this. And so essentially a line was drawn in the sand where our government, because they always do what's in our best interest, said, if you are putting money into this type of contract because you have too much cash for the amount of death benefit that you're purchasing, we are no longer going to classify this as life insurance. We're going to consider it to be an investment, and we are going to rename this contract a modified endowment contract, or a MEC. So that line, that red dotted line, basically says if I've got too much cash too fast into the policy, now instead of having tax-free access to the money, if you try to access the money before 59 and a half, you are going to pay a 10% penalty plus ordinary income taxes. So what used to be really sexy and exciting suddenly is not something that you would really want to do, because it feels a lot like having a 401k, except you don't get a deduction on the front end. So why would you do that? So if we're looking to fund a contract, we basically want to snuggle right up against that MEC line so we have maximum cash and still have tax-free growth and access in the contract. So what we do is we take a plain vanilla whole life insurance policy. We have that listed as whole life 95 because it's gonna accept premium for 95 years. But what we're gonna do is we're gonna attach a rider to this policy called paid up additions. And those paid up additions are essentially cash policies structured exactly like a single premium policy that we're sort of Frankensteining on top of a normal contract. So when you're funding one of these, the premium for the whole life is what you're really committing to. And for every dollar that you're putting to the whole life premium, you have the option to contribute up to $3 into paid up additional insurance, or essentially the cash portion of the policy. So I'm going to use a real girly analogy right now, but hopefully even the guys listening to this will understand it. The policy itself is kind of like buying a purse, and the paid up additions are the cash that you're sticking into the purse. And so when you look at that, if you buy a giant purse, there may not be any money left to stick into it. But if you buy a tiny little purse, it's not going to hold all your cash. So there is very much a balance between the amount of cash that you're trying to acquire inside of the policy and the size of the policy itself. But the goal is always to maximize the access to the cash. And what I'll tell you is, if you were looking at, for example, someone who is putting $10,000 a year into a contract, most life insurance agents are going to put all of that to the contract itself. And when you do that, there is little to no liquidity for the first 3 years of the contract. If you were, however, to say, I want to work closer to that 1-to-3 ratio, you'd put about $2,500 to the base premium and $75 to paid up additions, right? That would be the absolute maximum split that you could do there. If you actually did that in real life, you'd cross the line. But saying that you were on the right side of the MEC line after doing that, the agent who structured that policy just cut their compensation by 75%. Which is why you don't frequently hear agents talking about policies structured like this, because even though it makes more sense for you because you've got liquidity and a more efficient policy with a higher internal rate of return, what most agents aren't going to look at this and say, well, let me just cut my compensation by 75% because I like you. They're going to try and sell the policy that has a bigger commission. But when you do it this way, it becomes much more usable. So when we look at this, what I want you to see is, okay, if I funded a contract like this, how does this actually work? So we're going to go through just a quick example of a cash investment. And I know there's a lot popping up on the screen here, but stick with me. Let's say that you decided to put $100,000, or you've accumulated $100,000 in cash. And you've got that in your taxable account, but we aren't going to talk a whole lot about growth because there really isn't much in cash right now. So what you're going to do in this system is you're going to take the $100,000 out of your cash account. and you're going to make a hypothetical investment. So for this hypothetical, we are going to say that you are putting $100,000 into a real estate project. And this particular real estate project is going to earn 10% per year. So you get that 10%, that's $10,000. We know right off the bat that even as that income comes in, you're going to have to pay capital gains. So we're going to call that about 20% that you're losing in taxes. So you pay that at the end of the year and you end up with $8,000. So if you left your money in this investment for 10 years, you would have a net of $8,000 coming to you for 10 years. Easy math here, that's $80,000. So I want you just to hold on to that number because that's what's coming from the cash flow of the investment. And then at the end of 10 years, your original investment liquidates, and that original 100,000 that you've put in, let's just say it's worth 200,000 now. 100,000 of that is your principal, so there are no taxes on your principal because you'd already paid taxes on that. But you are going to have $100,000 of growth, and that is taxable. And so we're going to take another 20K out in taxes, assuming that this is all capital gains treatment, which means you've got left over $180,000. And so when we look at that, you have the 80,000 that came from cash flow, and you have 180,000 that came from the return of your 100 grand plus the 80,000 of capital appreciation on the investment. And so the total amount of money that you have back in your pocket is $260,000. And over that 10-year time period, you paid the IRS 40 grand in taxes, right? So pretty simple. Hopefully that was fairly easy to follow. What we're going to do now is exactly the same investment, but we're going to make it out of an insurance contract that has $100,000 of cash value. So we take a lien against it. All 100,000 continues to be invested. The insurance company is going to make a loan. Now we're going to do this loan at 5% because if you look at most insurance companies right now, for the type of contracts we need, their loan provisions are lower than 5% today. So we borrow the money, we keep our money earning, we take the loan at 5%. We're going to make exactly the same investment, earning exactly the same 10%. But now when we receive our $10,000, remember, we are accruing interest on that loan. And so we're going to make the decision to pay $5,000 directly back to the loan. So when I get my 10, if I have to pay 5,000 in interest, that 5,000 is an expense. And so it is no longer taxable income. That means I've got $5,000 left over that is taxable, and it's taxable at capital gains, which again is 20%. So I have to pay $1,000 in taxes, which means I have $4,000 still sitting in my pocket. So if I am netting $4,000 each year, and I do this for 10 years, I have $40,000. Now, this is very different than the 80,000 that we were talking about before. So far, I feel like I'm a little bit behind. The rest of this is going to look exactly the same. My original investment liquidates for $200,000. 100,000 of that is principal. We're immediately going to take that principal, which is not growth, so I don't have to pay taxes on it, and I'm going to pay the loan to the insurance company back. So that just goes right back into the policy. Then I have $100,000 worth of growth, so I have to pay my 20% in taxes on that. I net $80,000. So here's how this plays out, right? So we've got the $40,000 that came from cash flow. We have the $80,000 that was growth. And remember, we paid back our loan, but we kept the growth on the $100,000 that was in the policy. So that $100,000, because it continued to grow, is now worth $158,000. So if I add the 40K plus the 80K of growth plus the 158, I end up with $278,000 in my pocket, and I only paid the IRS $30,000. So I'm a happy camper because I figured out how to hold on to more of my money and give less money to the government. So to me, that is a win-win situation, right? And so when you look at the comparison between the two, simply by being more efficient, you end up with more money in your pocket over time. So just to compare, I'm ahead by $18,000 and I paid $10,000 less in taxes simply by being more efficient. So if I can do this over and over and over again, here I'm 18 grand ahead in the first 10 years, right, with this investment, but I also get to keep that 18,000 of growth compounding for the rest of my lifetime. So each transaction that I do this way could have an impact of tens of thousands, if not hundreds of thousands of dollars to me over my lifetime, right? And it's simply because I'm being more efficient with the purchasing. So I want to make sure I'm cognizant of time. We are at about 7:47. And so what I'd like to do now is open it up for questions. So Kara, if there are questions in the chat box, will you let me know? But if you have questions, go ahead and type them in the chat box and we'll get a chance to answer them for you. And while we're kind of waiting to see if there are specific questions that come in, I want to make sure that you guys know that whoever invited you to come and spend your evening with us is well versed in how these strategies work. And they can definitely take a collaborative approach and get to understand what it is that you are trying to accomplish, what it is you're trying to acquire. The best types of assets for this particular situation are assets that are going to produce cash flow if you're making investments. So this works whether you're buying a car, paying for a new set of tires, doing a remodel on your pool, or a remodel on your house. You could use the system to flip houses or acquire rental properties. And I'll give you an example of one of the things that I personally have done with mine, right? So the very first house that I bought when I was in my 20s was purchased using this particular system. And Kara, I can't see the chat box. So if you'll let me know what it says.
Everybody feel free to unmute yourself and ask Mary the question. I do see Ross Jim. How do you employ this strategy with a low retirement income is the first question. But anybody else, feel free to jump in, unmute yourself, ask in person.
Okay, so I'll let me kind of address this real quick. It doesn't necessarily take a whole lot of money to be able to do this. So the first thing that you have to do is build a foundation, and you start where you can start. So my first policy, I was actually gifted a policy that my parents had started when I was about 7 years old. And that policy had probably about $10,000 worth of cash value. And the premium on that contract was about $125 a month. That was the actual premium, but I could contribute up to $400 without creating a modified endowment contract. And so, there's been inflation since then, but I was making about $24,000 a year in income my first year at age 21 out of school. And I was able to save $400, right? I mean, my car was paid for at that point in time, but I paid all my other expenses, including my rent. And it actually was a joke among my friends that if you were going to invite me out, you were at least paying for my drinks and you might be paying for my dinner. Because otherwise I just wouldn't come because I was trying to save the money. And I was living that way because my parents told me you save 20% of your income. Well, when you're making $2,000 a month, 20% of your income is $400. And so that's what I was like, oh, this is what you do when you're a grown up. And so I don't think that math works today just because of inflation on those dollars, but it doesn't take a whole lot to get started. And so we have clients who start where they can start, and maybe they are just building up the capital to do this. I can tell you that I have had clients who have launched companies because they used their first, $3,000 that they accumulated here to buy some inventory, which they then sold on the internet through Instagram. And so it doesn't have to be something big to get you started. It could be that you're just building enough so that if you have to buy a new set of tires for $800, you at least can capture the growth on that. What happens over time is that you will begin to expand the system, because as you're able to hold on to more and more growth and you're able to add what you are holding on to into your system, you'll end up with more money sitting there than you could have expected.
We have another question from Michelle. She asked, doesn't the insurance costs get a lot more expensive as you get older, negating the cash flow, aka the more expensive the insurance, the more it eats the cash flow?
So I'm gonna answer this question, I think the best way I know how. So Michelle, if it doesn't answer the question that you're asking, feel free to unmute yourself. You should just be able to click on that and let me know. But when you look at what happens, there's two types of permanent insurance. There's permanent insurance that is built on a universal life chassis, and there's permanent insurance that's based on a whole life chassis. If you look at the whole life chassis, they've levelized the expenses inside of the policy. So once you buy a policy, the expenses are set. So is a policy more expensive as you get older? Yes, a little bit, because they're trying to recover the expenses in a shorter period of time. But again, these systems work until you get into your late 60s. So if you're looking at the math on that, once you hit about 68, the insurance no longer is going to produce any type of return that is going to be in your favor. But up until that point, it works. On a universal life chassis, what happens is the expenses inside of the policy are really low when you're younger, but they increase every year as you age. So there are certainly types of policies that make more sense to do this from. And we prefer doing it from a whole life policy to any other type of policy that's on the market today. And so if you want to go into kind of a technical conversation about that, we're more than happy to do it. But the math works on this for quite some time. And even if you're acquiring a policy in your 50s or in your 60s, the reality is that you have decades most likely ahead of you. And if you can retain the compounding on your money over those decades, it can really help you over a lifetime.
We also have a question from Bill.
Mhm.
He says, thanks, Mary. Can you use this for a child's education funding, or would it be better to use a 529 plan?
I feel like you just lobbed me a softball, Bill. I really do. So I actually use this for my kids' college funding, and this is something I go back and forth with our clients. But I think we're probably going to do a college funding class here coming up, because this is a conversation that has been coming up quite a bit. So especially if your kids are younger when you start this and you have time to overcome the cost of insurance and get into really some of the compounding and the growth, this can be a really, really good way to help your kids out. So there's two ways you can do it. And we just went through this example for a client of ours. So she was funding 529 for college, but she asked some questions such as, if my kids get a scholarship, what happens to this money? If they decide not to go to college, what happens to this money? And the sort of lack of control or the penalties if you decide to use the money for something else, I think can be detrimental. I will also say, and we have clients that do 529s and we manage for them. But one of the things that has always concerned me, because I've seen this happen, especially with kids who are from my generation, is that parents did a great job. They saved for college. Kid number one, who's my age, got everything paid for. Child number two, who's several years behind. I graduated in 2003. I have friends who have siblings that were in school during 2008, and they lost money either from an account or from a 529. And then their parents, because not only did they lose college fund money, but they lost their own retirement money, we're not in a position, either because of a job loss or anything of that nature, we're not in a position to pay for the entirety of youngest sibling's school. And so I have seen situations where families are torn apart because child number one had a full ride. Child number two ended up with 2 years worth of student loans. The parents can't afford to pay the student loans. They approach the other sibling and say, hey, would you split these with me so it's fair? And older sibling is like, heck no, what? No, I'm not taking on your debt. And so it has really created some tension. And I look at that and I think for myself, I would rather have to put more money into an account and have the guarantees and the certainty than have money at risk. So some of our clients split it because they feel otherwise. But when it comes down to it, there are two ways that you can fund a policy for college education. So with one of our clients, we built a complete model where we showed, here's what it is if you put it into a 529, and then you delay putting that money towards your own retirement because you've got to be funding for college. So then the second option was you save all of the money towards policies and your investments. So we put it in the policy, and then you take a loan to pay for the kids' college education. And then you redirect the cash flow to pay the loan back, and you're no longer funding the insurance. And what we found for this particular client is that doing it that way created an extra $50,000 a year of income for her versus if she paid cash for college using a 529. So some of our clients choose to do it that way, especially if they're worried about their own retirement, because it allows them to pay for the kids' college education and retire with more because they aren't interrupting the compounding. What I've chosen to do, because I feel pretty good about the direction that I'm headed for retirement, is that I have funded policies for my kids. So each of them have their own policies, which we fund so that they'll have money for college. But along the way, we get to do other things with it. So when they have braces, right, they get to pay for it out of the policy, and then they'll go through the motions of paying it back. When we get ready to buy their first car, we'll buy the car from the policy, and then we'll work on paying that back, so that by the time they graduate from college, they will have this asset that they have built and had use of. But let's say college costs $200,000 by the time my kids are in school, or $400,000. If they have 200 grand and they get a loan, yeah, I'm going to expect them to pay that loan back, but they have $200,000 that is continuing to earn and compound for them. So if I had just paid 200 grand for college and they were starting from scratch, they're going to save exactly the same amount as they would be paying back to that loan from the insurance company, but they're only getting compounding on their $200 a month contribution. And then they're only getting that compounding whenever they get it on the compound growth curve, right? So they got to build their emergency fund first. So if their cash flow is the same from a savings perspective, because they can start and stop and put however much they want back, if I can keep the compounding on 200 grand for an extra 20 years, because I've been saving from the moment they were born and they don't interrupt that, when you think about the compound growth curve, and I'm just going to draw it on a sheet of notebook paper, it looks like this, right? It gets bigger and bigger. And so if they start 20 years later, they get all of the beginning. What they lose is the best growth on the back end. And so if I can keep them on the compound growth curve that we started when they were babies, they're going to have way more money. And then how this integrates into the income maximization strategies is going to be huge on the back end. So that's a long-winded answer, but I would definitely recommend that we have kind of a longer conversation if you want to get technical.
We have one more question with concerns for college fund from Reagan. It's, what is the max you can contribute for young kids? Seems like it wouldn't be much. And then we have another question after that.
Okay, so the maximum that you can contribute for your children is based on what you have in place for yourself. So most of the insurance companies that are out there and doing business that you would actually want to purchase policies from are going to require that whatever death benefit you put on your kid, you have to have twice that on yourself. So this, again, we're going to fund it for cash growth and liquidity, which means there's less death benefit for how we're funding it. But the insurance companies don't care if you've got term or permanent coverage when you're looking at your kids. So I started policies for my kids when they were 15 days old, because that was the earliest that I could do it. And for them, I pay, so for $1 million policy, the premium's probably about $300 a month. And then what I do is I overfund that. So I'm putting about $600 or $700 a month into each of their contracts, because it's very important to me to be able to do that. But that's just $1 million policy at that point. And so, you know, as long as I have 2 million of coverage on myself, that can be on a term policy and I can still do this for my kids. So what I find is most people don't put that much towards their kids' college education. Most people are funding $200-300 a month, but it really depends on what you want to do. If you wanted to fund something much larger and you had more death benefit on yourself, you could.
Okay, the next question we have is, I remember years ago you mentioned the most efficient time to add paid up additions into a whole life policy is in the first 5 years. With a policy that is 10 plus years old, is it still efficient to continue adding?
So the answer to that is yes, it is still efficient to continue adding, right? Once you get a policy that's older and more seasoned, we definitely want to make sure that we aren't going to cross that modified endowment contract line. But I want to address the efficiency comment real quick. What happens in a contract in the first 3 to 4 years is that because the bulk of the base premium is actually paying for your death benefit, those paid up additions are really what are driving compounding. So if you can max out the paid up additions in the first 3 to 4 years, that's actually going to materially increase the internal rate of return on your policy at the time. Can you mute whoever has the vacuum or whatever it is going in the background? Just mute yourself. Can you maybe mute them, Kara?
Got it. You're good.
Okay, thank you. So I'm sorry, that was just very distracting. So what you're looking at in the first 3 to 4 years is that your contributions actually increase the internal rate of return. And depending on the interest rate environment, those contributions over the life of your policy could increase the return anywhere from 25 basis points to 1.5%. And so it's very important, if you can, in the early years of the policy, to kind of max it out and get as close to that MAC line as possible. The money that is put into the paid up additions in year 10 or 12 or 25 is still going to get more money onto the compound growth curve, and it is going to grow what you have access to, but it's not going to materially change the internal rate of return of the policy. And so that's really what I'm referring to when I talk about that, is that in the early years, you can juice the growth that you're going to experience over the life of the policy. Beyond year 4, the money's still on there. It's still compounding. It's grown the bucket of assets that you can borrow against. But you know, there you have it. And usually what I do when I get to the point where I'm in year 5 or year 10 is that I will redirect money that was going to the paid up additions to open another policy. Because if I can get to the point where my policy can sustain itself because of the contributions that I've made, then I don't have the obligation to keep putting money in there. So I usually pay the base premium at that point and open a new policy, because now I have a bigger window for how much money I can contribute. And so if you're actively using the system to acquire other investments, and those investments have cash flow, not only are you replenishing the loan you took, but hopefully you're also growing the paid up additions. And so the policies that I started early on, like the one that was $125 a month that I could put $400 in, I've outgrown that because I have investments that are producing more than $400 a month, and I need a place to put that cash flow. So most people end up with a system of policies over time based on a combination of the normal income growth that you might experience over the course of a lifetime, plus the additional assets they've acquired and the cash flow that those assets are producing. Long-winded answer, but hopefully it answered the question. Any other questions in there, Kara?
Looks like that's all the questions we have for now, and we're also out of time.
Okay, perfect. So it's just after 8 o'clock. I would highly, highly encourage you to reach out to the person that invited you, and they can have more conversations that are certainly personalized for you and for what you're looking for. And if you have additional questions, also feel free to just let us know. If there's a topic that you would be really interested in learning about, or you want a more in-depth advanced class on this topic, please, please, please tell the person who introduced you, because that feedback is how we know what kind of content to create, both on our social media, our newsletter, and then even for these webinars that we're doing. Thanks again for joining us tonight. We really appreciate your time. I hope you have a great evening and a great rest of the week.